Question 1. Which of the following is a key difference between first-party claims and third-party claims? A. First-party claims are made by the insured against the insurer, while third-party claims are made by the insurer against a third party. B. First-party claims are made by the insurer to cover damages, while third-party claims are only for personal injury. C. First-party claims are typically for personal injury, while third-party claims are for property damage. D. First-party claims are filed when the insured's property is damaged, while third-party claims arise when someone else's property is damaged due to the insured's actions. Answer: D. First-party claims are filed when the insured's property is damaged, while third-party claims arise when someone else's property is damaged due to the insured's actions. Explanation: First-party claims are filed by the insured against their own insurance company, typically when their own property is damaged or lost. Third-party claims, on the other hand, involve a claim filed by a third party, someone other than the insured, against the insured's insurance company, often when the insured is liable for damages to the third party's property or person. For example, if a driver causes an accident and damages another person's car, the third party files a claim against the insured's liability coverage. Question 2. Scenario: Mrs. Roberts, a claims adjuster, is assigned to evaluate a property damage claim for a homeowner whose house was severely damaged in a fire. The homeowner claims that some of the damaged property, such as furniture, had a replacement value of $15,000, but the adjuster's evaluation reveals that the actual cash value (SCV) is significantly lower at $10,000. Taking depreciation into account, the homeowner insists on receiving the full $15,000 replacement cost. What should Mrs. Roberts explain to the homeowner about the difference between replacement cost and ACV? A. The ACV considers depreciation and provides a fair value based on the property's current state, while replacement cost would cover the full amount to replace the damaged property with new items. B. The ACV reflects only the price the homeowner originally paid for the items, and the replacement cost is based solely on what it would cost to repair the home, not the furniture. C. The ACV is based on how much it would cost to replace the property with like-kind materials, while replacement cost only considers the repair cost, not the value of the original items. D. The replacement cost is generally lower than SCV because depreciation isn't considered in the calculation of replacement cost. Answer: A. The ACV considers depreciation and provides a fair value based on the property's current state, while replacement cost would cover the full amount to replace the damaged property with new items. Explanation: Actual cash value (SCV) reflects the depreciated value of damaged property considering the wear and tear or age of the property, while replacement cost coverage pays the full cost to replace the property with a similar brand new item without accounting for depreciation. In this scenario, Mrs. Roberts should explain that the insurance policy provides coverage for ACV unless the policy specifically includes a rider for replacement cost coverage. Question 3. What is the primary purpose of the Montana Fair Claims Settlement Practices Act? A. To establish a specific time frame for insurers to approve or deny claims, ensuring fair treatment of policyholders. B. To provide guidelines for how insurance adjusters should evaluate and settle claims with a focus on minimizing the insurer's payout. C. To protect the rights of insurance adjusters by ensuring they receive fair compensation for the claims they handle. D. To create an independent agency responsible for overseeing all insurance claims made in Montana, regardless of the insurer. Answer: A. To establish a specific time frame for insurers to approve or deny claims, ensuring fair treatment of policyholders. Explanation: The Montana Fair Claims Settlement Practices Act aims to protect consumers by setting clear standards for the handling and settlement of insurance claims. It mandates that insurers must act in good faith and settle claims promptly. The Act requires insurers to notify claimants of the status of their claims within a reasonable period and outlines specific timelines for approving or denying claims. This ensures that policyholders are treated fairly and not left in limbo during the claims process. Question 4. What is the primary role of the claims adjuster in the insurance claims process? A. To make final decisions on the insurance company's coverage policies. B. To investigate the facts surrounding the claim, evaluate damages, and determine the compensation due to the policyholder or third party. C. To market insurance products to potential customers. D. To determine whether or not a policyholder is eligible for insurance coverage. Answer: B. To investigate the facts surrounding the claim, evaluate damages, and determine the compensation due to the policyholder or third party. Explanation: The primary role of the claims adjuster is to conduct thorough investigations of claims to determine the cause of the loss, the extent of damages, and the amount of compensation due. This involves reviewing policy details, interviewing the claimant and witnesses, inspecting the damage, and consulting with experts. The adjuster ensures that the claim is evaluated fairly and settled according to the terms of the policy and applicable laws. While the adjuster does not market products or make eligibility decisions for insurance, they play a critical role in the claims evaluation and settlement process. Question 5. In Montana, what is the statute of limitations for filing a claim for property damage under most insurance policies? A. 1 year. B. 2 years. C. 3 years. D. 4 years. Answer. B. 2 years. Explanation. Under Montana law, the statute of limitations for filing a property damage claim is generally 2 years from the date of loss or damage. This means that a claimant must initiate the claim process or file a lawsuit within 2 years of the incident that caused the property damage. Failing to do so may result in the loss of the legal right to pursue the claim. It's crucial for claims adjusters to be aware of this limitation to ensure they properly advise clients and process claims within the allowed time frame. Question 6. Scenario. Mr. Davis was driving his car when he collided with another vehicle. The other driver was found to be at fault, but Mr. Davis's car was severely damaged. The other driver's insurance company has offered to settle the claim for the damage caused to Mr. Davis's car, but Mr. Davis believes the offer is too low and does not reflect the true value of the damages. What should Mr. Davis do next in order to reach a fair settlement? A. Mr. Davis should accept the settlement offer and file a lawsuit against his own insurer. B. Mr. Davis should file a claim under his own insurance policy for the damage to his vehicle. C. Mr. Davis should request a higher settlement amount from the other driver's insurance company by providing additional evidence of the vehicle's value. D. Mr. Davis should go to court immediately to resolve the matter without negotiating. Answer. C. Mr. Davis should request a higher settlement amount from the other driver's insurance company by providing additional evidence of the vehicle's value. Explanation. In situations where the insurance company offers an amount that the claimant believes is insufficient, the claimant, Mr. Davis in this case, has the right to negotiate for a higher settlement. He can present additional evidence, such as repair estimates, photographs, or the car's market value, to support his case. Filing a claim with his own insurance company, option B, could be an alternative, but it typically would involve his own policy deductible. Going to court without negotiation, option D, could be premature and costly. Settlement through negotiation is usually the best route unless the insurer is acting in bad faith or refuses to meet reasonable settlement demands. Question 7. What is the definition of bad faith in the context of insurance claims adjusting? A. When an insurance adjuster deliberately overestimates the value of a claim to benefit the insurer. B. When an insurer denies a claim without a reasonable basis or fails to promptly pay or settle a claim. C. When an adjuster settles a claim for an amount that is higher than the insurer's policy limit. D. When an insurance company refuses to communicate with the policyholder about the status of the claim. Answer. B. When an insurer denies a claim without a reasonable basis or fails to promptly pay or settle a claim. Explanation. Bad faith refers to an insurer's unfair or unethical treatment of a policyholder, such as denying a legitimate claim without a reasonable basis, delaying the settlement of a claim without justification, or failing to conduct a proper investigation. Bad faith practices can lead to legal action against the insurer and may result in additional damages being awarded to the claimant. It's important for claims adjusters to always act in good faith, ensuring that claims are processed fairly and efficiently according to policy terms and legal requirements. Question 8. Which of the following is true about the use of depreciation in adjusting property damage claims? A. Depreciation is always included in the settlement amount, regardless of the policy type. B. Depreciation is considered when calculating the actual cash value (SEV) of the damaged property. C. Depreciation is never considered when determining the claim payout. D. Depreciation only applies when the damage is from a natural disaster such as a flood. Answer. B. Depreciation is considered when calculating the actual cash value (SEV) of the damaged property. Explanation. When adjusting a property damage claim, the actual cash value (SEV) is calculated by subtracting depreciation from the replacement cost. This accounts for the wear and tear or age of the damaged property. Depreciation reflects the reduction in value of the property over time. For example, if a 10-year-old television is damaged, the replacement cost for a new TV may be $1,000, but the ACV would consider how much value the TV lost over 10 years, resulting in a low payout. Replacement cost coverage, on the other hand, would pay for the cost to replace the property with a new item without accounting for depreciation. Question 9. What should an insurer suggest to do if they suspect a claim is fraudulent? A. Ignore the signs and proceed with the claim as usual. B. Deny the claim immediately without investigation. C. Report the suspected fraud to the insurance company and allow them to investigate further. D. Pay the claim but reduce the payout amount based on the suspected fraud. Answer. C. Report the suspected fraud to the insurance company and allow them to investigate further. Explanation. If an insurer suggests suspects fraud, they have a legal and ethical obligation to report the suspicion to the insurance company. The insurer then has the responsibility to investigate the claim thoroughly, often with the assistance of special fraud investigation units or third-party experts. Fraudulent claims can involve false reporting, exaggeration of damages, or staged accidents. The adjuster should not take matters into their own hands by denying the claim or reducing the payout. Fraud detection is critical in maintaining the integrity of the insurance industry. Question 10. What is the purpose of endorsements or riders in an insurance policy? A. To modify the insurance company's payment structure. B. To extend or limit coverage by adding or removing specific protections. C. To provide a detailed list of the insured's assets. D. To guarantee payment of a claim in all circumstances. Answer. B. To extend or limit coverage by adding or removing specific protections. Explanation. Endorsements or riders are modifications made to the base insurance policy to either add, remove, or alter specific coverage provisions. They allow the policyholder to customize their policy to better fit their needs, such as adding coverage for valuable items like jewelry or removing exclusions for certain types of damage. For example, a homeowner's policy might include an endorsement for flood coverage if it was originally excluded. These adjustments can significantly affect the coverage and premium cost of the policy. Question 11. Which of the following is typically excluded from a standard homeowner's insurance policy? A. Fire damage. B. Theft of personal property. C. Flood damage. D. Vandalism. Answer. C. Flood damage. Explanation. Most standard homeowners insurance policies exclude flood damage. Homeowners in flood-prone areas are usually advised to purchase a separate flood insurance policy through the National Flood Insurance Program (NFIP) or a private insurer. Floods are considered a distinct risk and require specific coverage. Fire, theft, and vandalism are typically covered under a standard homeowners policy. Question 12. What is the key difference between replacement cost and actual cash value in property insurance? A. Replacement cost refers to the cost of replacing the property, while actual cash value accounts for depreciation. B. Actual cash value refers to the cost of replacing the property, while replacement cost accounts for depreciation. C. Replacement cost includes labor costs, while actual cash value does not. D. There is no difference between replacement cost and actual cash value. Answer. A. Replacement cost refers to the cost of replacing the property, while actual cash value accounts for depreciation. Explanation. Replacement cost is the amount it would take to replace the damaged or destroyed property with a similar item without factoring in depreciation. In contrast, actual cash value (ACV) includes depreciation, meaning the payout reflects the depreciated value of the property at the time of loss. For example, if a 5-year-old refrigerator is damaged, replacement cost would cover the price of a new refrigerator, while ACV would subtract depreciation based on the refrigerator's age. Question 13 scenario. Sarah's home was damaged by a storm and her insurance company provided an estimate for repairs. However, after receiving multiple repair bids, Sarah believes the initial estimate was too low. What is Sarah's best course of action? A. Accept the insurance company's estimate without further dispute. B. File a lawsuit against the insurance company immediately. C. Negotiate with the insurance company by providing additional repair bids or documentation. D. Cancel her insurance policy and seek coverage elsewhere. Answer. C. Negotiate with the insurance company by providing additional repair bids or documentation. Explanation. Sarah has the right to dispute the insurance company's initial estimate if she believes it does not reflect the true cost of repairs. She can present alternative repair bids or documentation to support her case and request a reevaluation of the estimate. Negotiating with the insurer is often the most effective way to ensure a fair settlement. Legal action or policy cancellation should be considered only if negotiations fail and the insurance company is acting in bad faith. Question 14. What is a deductible in the context of an insurance policy? A. The amount the insurer will pay for a claim. B. The amount the insured must pay out of pocket before the insurer pays a claim. C. The total amount of insurance coverage provided under the policy. D. The cost of the insurance premium. Answer: B. The amount the insured must pay out of pocket before the insurer pays a claim. Explanation: a deductible is the portion of the claim that the policyholder must pay out of pocket before the insurance company begins to pay. For example, if a policyholder has a $500 deductible and a $2,000 claim, the policyholder would pay the first $500 and the insurer would pay the remaining $1,500. Deductibles are designed to reduce the number of small claims filed and to keep premiums affordable. Question 15. Which type of insurance policy typically provides coverage for businesses in the event of a loss of income due to a covered peril? A. Professional liability insurance. B. Business interruption insurance. C. Life insurance. D. Workers' compensation insurance. Answer: B. Business interruption insurance. Explanation: business interruption insurance provides coverage for a business's loss of income due to a covered peril such as fire, storm damage, or other events that prevent the business from operating. It helps businesses cover ongoing expenses, including payroll and rent, during the period of interruption. This type of insurance is crucial for businesses that rely on continuous operations. Question 16. What is underwriting in the context of insurance? A. The process of selling claims after a loss occurs. B. The process of assessing risks and determining premiums for insurance policies. C. The process of marketing and selling insurance policies to potential customers. D. The process of negotiating settlement offers between the insurer and policyholders. Answer: B. The process of assessing risks and determining premiums for insurance policies. Explanation: underwriting is the process by which insurers assess the risks associated with a potential policyholder and determine the appropriate premium for the coverage. The underwriter evaluates factors such as the policyholder's age, health, property condition, and history of claims to assess the risk level. The goal is to ensure that the insurer receives adequate premiums to cover the potential claims while maintaining profitability. Question 17. Which of the following is an example of a peril typically covered by a standard homeowner's insurance policy? A. Earthquake. B. Flood. C. Fire. D. Terrorism. Answer: C. Fire. Explanation: fires are typical peril covered by most standard homeowners insurance policies. These policies provide coverage for damage to the home and personal property resulting from a fire. However, certain perils like earthquakes and floods often require separate policies or endorsements. Terrorism coverage may also require an additional rider or be excluded depending on the insurer. Question 18. What is the purpose of an exclusion in an insurance policy? A. To specify the types of risks and damages that are covered by the policy. B. To describe the amount the insured must pay before the insurance kicks in. C. To clarify the rights and responsibilities of the policyholder. D. To identify the risks or damages that are not covered by the policy. Answer: D. To identify the risks or damages that are not covered by the policy. Explanation: an exclusion in an insurance policy outlines specific risks, conditions, or damages that are not covered by the policy. For example, most homeowners' insurance policies exclude damage from floods or earthquakes unless additional coverage is purchased. Exclusions are essential for limiting the insurer's liability and defining the scope of coverage. Question 19. What is the primary function of the insurance binder in the insurance process? A. To provide temporary proof of coverage until the formal policy is issued. B. To negotiate the terms of an insurance contract with the insurer. C. To determine the amount of coverage a policyholder is eligible for. D. To calculate the premium rate based on the policyholder's risks. Answer: A. To provide temporary proof of coverage until the formal policy is issued. Explanation: an insurance binder is a temporary document issued by an insurance company that provides proof of coverage while the formal insurance policy is being processed. It is typically issued for a short period and serves as confirmation that the insurer has accepted the risk and the policyholder is covered. The binder becomes void once the actual policy is issued. Question 20. Scenario: A homeowner's insurance policy includes coverage for water damage caused by burst pipes. However, the homeowner finds that the water damage resulted from a leaky roof which was not repaired in time. Will the insurance policy cover the damage? A. Yes, as water damage is covered regardless of the source. B. Yes, because roof damage is typically covered under standard policies. C. No, because the damage was caused by neglect, which is often excluded. D. No, because water damage from a roof leak is never covered. Answer: C. No, because the damage was caused by neglect, which is often excluded. Explanation: homeowners insurance typically does not cover damages resulting from neglect or lack of maintenance. In this case, the water damage from the leaky roof is excluded because it resulted from the homeowner's failure to repair the roof in a timely manner. Insurance policies usually cover accidental or sudden damage, not damage from neglect or wear and tear. Question 21. Which of the following is true regarding the insurable interest requirement in insurance? A. The policyholder must have a financial stake in the property or life being insured. B. The policyholder can insure any property regardless of ownership or financial interest. C. Insurable interest is not necessary for life insurance. D. Insurable interest is only required for auto insurance policies. Answer: A. The policyholder must have a financial stake in the property or life being insured. Explanation: for an insurance policy to be valid, the policyholder must have insurable interest, meaning they must have a financial stake or interest in the property or person being insured. This requirement ensures that the insurance is not used as a form of gambling. For example, you cannot purchase life insurance on a person unless you are related to them or have a financial relationship. Question 22. Which of the following is a typical benefit of purchasing an umbrella insurance policy? A. It increases your home insurance coverage limit for specific types of damages. B. It provides additional coverage for incidents not covered under auto or home policies. C. It covers the deductible of your other policies. D. It provides coverage for damages caused by intentional acts. Answer: B. It provides additional coverage for incidents not covered under auto or home policies. Explanation: an umbrella insurance policy offers extra liability coverage above and beyond the limits of your existing home, auto, or other insurance policies. It is designed to provide financial protection in case of major claims or lawsuits, covering events not included in other policies, such as libel or slander. Question 23. Scenario: John has a life insurance policy with a $200,000 benefit. He has named his spouse Mary as the beneficiary. If John passes away, will Mary receive A. $200,000 minus any outstanding loans on the policy? B. $200,000 minus any taxes due on the policy? C. $200,000 unless the policy has a specific exclusion for the cause of death? D. $200,000 unless John has a valid will stating otherwise. Answer: A. $200,000 minus any outstanding loans on the policy. Explanation: when the insured person, John, passes away, the beneficiary, Mary, is generally entitled to the death benefit, which is the face value of the policy minus any loans or unpaid premiums. The death benefit is usually tax-free, but if there are exclusions in the policy, like for suicide or death within a contestability period, they may apply. Question 24. Which of the following would be considered a covered peril under a typical homeowner's insurance policy? A. Damage caused by an earthquake. B. Loss of income due to business interruption. C. Theft of personal property. D. Flood damage. Answer: C. Theft of personal property. Explanation: theft of personal property is typically covered under standard homeowners insurance policies. Earthquake and flood damage are usually excluded unless additional coverage is purchased. Loss of income due to business interruption requires a specific type of insurance, such as business interruption insurance, not a standard homeowner's policy. Question 25. What is subrogation in the context of insurance? A. The process of determining the premium amount for a policyholder. B. The act of an insurance company seeking reimbursement from a third party after paying a claim. C. The practice of combining multiple insurance policies into one. D. The procedure for cancelling an insurance policy. Answer: B. The act of an insurance company seeking reimbursement from a third party after paying a claim. Explanation: subrogation occurs when an insurance company pays for a claim on behalf of its insured and then seeks to recover the amount from the responsible party or their insurance company. For example, if you are involved in a car accident caused by another driver, your insurance may cover the damages initially, but they will seek reimbursement from the other driver's insurance company through subrogation. Question 26. Which of the following is not typically covered under a standard renter's insurance policy? A. Personal property damage due to fire. B. Liability for injury to guests in the rental property. C. Damage to the building caused by flooding. D. Medical payments for guests injured in the rental property. Answer: C. Damage to the building caused by flooding. Explanation: Standard renters insurance does not cover damage to the building or structure itself, as this is usually the responsibility of the landlord's property insurance. Renters insurance primarily covers personal property liability and medical payments for injuries to others while on the premises. Flood damage typically requires a separate flood insurance policy. Question 27. What does the coinsurance clause in a property insurance policy typically require? A. The policyholder must insure the property for its full value, or they will receive a reduced payout in case of a claim. B. The insurer and policyholder share the cost of premiums equally. C. The policyholder must provide a deductible before the insurer pays any claims. D. The insurer is required to cover all costs of repairs or replacement without limitations. Answer: A. The policyholder must insure the property for its full value, or they will receive a reduced payout in case of a claim. Explanation: The coinsurance clause in property insurance requires the policyholder to insure the property for a certain percentage of its total value, usually 80%, 90%, or 100%. If the property is underinsured, the insurer will reduce the payout proportionally in the event of a claim. For example, if a policyholder insures their property for only 70% of its value and suffers a loss, the insurer will pay only 70% of the claim amount. Question 20. Which of the following is an example of a moral hazard in insurance? A. A driver who speeds frequently because they know they have auto insurance. B. A homeowner who installs a security system to reduce the risk of theft. C. A business owner who installs fire sprinklers to reduce the risk of fire damage. D. A person who refuses to buy insurance because they believe it is unnecessary. Answer: A. A driver who speeds frequently because they know they have auto insurance. Explanation: A moral hazard occurs when a person takes on more risk because they know they are covered by insurance. In this case, the driver may engage in reckless behavior such as speeding because they know their insurance will cover the costs if an accident occurs. Insurance companies aim to minimize moral hazards by encouraging policyholders to adopt safer behaviors. Question 29. What is loss of use coverage in a homeowner's insurance policy? A. Coverage for damage caused by negligence or intentional acts. B. Coverage for the cost of renting a temporary residence if the insured home is uninhabitable due to a covered event. C. Coverage for legal fees in the event of a lawsuit. D. Coverage for damage to personal property caused by fire, theft, or other perils. Correct answer: B. Coverage for the cost of renting a temporary residence if the insured home is uninhabitable due to a covered event. Explanation: Loss of use coverage helps pay for living expenses if a covered event such as a fire or storm makes the insured home uninhabitable. This coverage can help pay for hotel bills, rent, and other living costs while the home is being repaired or rebuilt. Question 30. Which of the following is a key difference between whole life insurance and term life insurance? A. Whole life insurance provides coverage for a specific period, while term life insurance offers lifetime coverage. B. Whole life insurance builds cash value over time, while term life insurance does not. C. Whole life insurance is generally less expensive than term life insurance. D. Whole life insurance is more flexible in terms of premium payments compared to term life insurance. Answer: B. Whole life insurance builds cash value over time, while term life insurance does not. Explanation: Whole life insurance provides lifetime coverage and also accumulates a cash value over time, which can be borrowed against or used as an investment. Term life insurance, on the other hand, provides coverage for a specific period, e.g. 10, 20, or 30 years, and does not build any cash value. While term life insurance is typically less expensive than whole life insurance, it does not offer the same benefits.